My name is Alex Pagano, loan officer and vice president of Loans Incorporated. Today we're going over three things you must consider before getting a DSCR loan. First and foremost, a DSCR loan qualifies the property, not you as the individual buying or refinancing the home. This means we're not asking for your pay stubs, we're not asking for your W-2s, we're not asking for your tax returns. All we're looking at is the income from the property via the appraisal. The first thing you must consider before getting a DSCR loan is whether or not you want to close in your personal name or LLC. People prefer to close in an LLC due to numerous reasons, but the two major reasons are tax purposes and personal liability mitigation. If these are two things of your concern about keeping personal liability off of your name with the property or saving on potential taxes, you should highly consider closing your home in an LLC. One particular thing you must look at if you're looking to refinance your loan into a DSCR loan closing in a new LLC is transfer tax. Many states have a transfer tax that they charge you for doing this. Being in Pennsylvania, if you're looking to refinance out of your personal name into an LLC, you're going to have to pay transfer tax, and this can add up pretty quickly. Also, some extra benefits with a DSCR loan closing your LLC is not having loans show on your credit report. A lot of people prefer the new mortgage to not show on their credit report, and closing an LLC can guarantee this. The second thing you must consider are your long-term plans for the property. The reason why I say this is most people, when they're getting a DSCR loan, they're looking at adding a prepayment penalty option. And the reason people add prepayment penalty to their loan is because the more prepayment penalty you have, and for the longer amount of time you have it, the lower your interest rate is. So let's take a look at an example of a prepayment penalty. Prepayment penalty options usually come in 1 to 5 year increments. So people will be offered a 1 year prepayment penalty, a 3 year prepayment penalty, a 5 year prepayment penalty. Typically, every 2 years, the rate drops about 0.25%. When you have a 7% interest rate on your loan and you add a 3 year prepayment penalty, usually your rate will drop between a quarter to maybe even 0.3%. This can be a good savings each month on your monthly cash flow. But remember, if you are to refinance before your prepayment penalty period ends, you're going to be paying a penalty, hence in the name penalty. So what might this penalty be? There's two options for prepayment penalty. You have a fixed prepayment penalty, which is a percentage of the original loan amount, or a tiered prepayment penalty option. And this pretty much means if you have a 5 year prepayment penalty, each year it goes down a percentage. So year one is a 5% penalty. Year two is a 4% penalty. Year three, and it keeps going down a percentage each year until you have no prepayment penalty left. And the third thing you must consider before getting a DSCR loan is, why are you getting a DSCR loan? Is because you saw a TikTok, a reel about a DSCR loan and think it's the best option as an investor? Or do you just not want to close in your personal name and close in an LLC? Most people who use DSCR loans are self-employed or have multiple rental properties and are looking not to qualify based off of their personal income. If you have a great W-2 job, you don't own any properties, or you may have a couple rental properties, and your loan would work showing your full documentation, I typically always recommend to go with a regular conventional loan. Now, an extra benefit of the DSCR loan, you can put 20% down on an investment property compared to 25% down with a conventional loan. However, if you're looking to put 25% down either way, and you can qualify for a conventional full doc loan, full doc meaning your W-2s, your pay stubs, your tax returns, you might be better off just going with a regular conventional loan. Now, if you're like, well, Alex, I want to close in my LLC and you can't do that with a conventional loan, what can you do? So what you can do is you can close in a full doc loan, meaning your pay stubs, your W-2s, your tax returns, all your income sourcing documents for yourself as a person, but you close in your LLC using a non-QM loan on investment property. So still the same benefits. Still, you can put 20% down, which is less than 25% down, in closing your LLC and receive an interest rate lower than a DSCR. So DSCR loans are great if you're self-employed, you already own a ton of properties, you're not sure where your taxes are, and you're looking to scale, 100% of the way, DSCR loan is the way to go. So before you look into DSCR loans, make sure you consider these three things. And if you ever have any questions about DSCR loans, let me know. I can lend on these loans in most part of the United States. So if you have any questions or want me to run a scenario for you, feel free to reach out to me anytime. All my information is the link in my bio.